Afternoon, ladies and gentlemen, boys and girls. Welcome to the Liberty Call. It is Tuesday, the 25th of October. Hope everybody's having a great day out there. It is kind of overcast here in Colorado. It was bright and sunny earlier today. I had to make a grocery run and drop a few $100s on groceries. And first time I filled up my tank in my big old truck since I got back from New Hampshire, because there was still a bunch of fuel in the reserve tank, and it took plus I don't drive a lot these days, and or we take my wife's car because it has better fuel economy than an F-350. But anyways, I apologize for being a little bit late, about 20 minutes behind schedule. So if it's your first time watching, please smash that subscribe button. I would greatly appreciate it. You want to get notified every time I go live and talk about all the important things that happen in the stock market and the economy. Also, give me the big old thumbs up, like, shares, and all that good stuff. I would greatly appreciate it. And share with some friends. You know, they may get something out of it. And I try to be funny, not always, but I do my best. All righty. Pretty good day in the market again. Certainly, it's good to see some green. And the Asian markets were, or at least China was pretty red again today, but certainly not as bad as yesterday. And we'll talk a little bit about why that happened. So some of y'all out there might be, wonder why the Chinese markets, tumbled so greatly yesterday. So, all right, well, let's go ahead and jump in and look at the indexes. The Dow Jones was up 1.07%, closed at 31,836. S&P was up 1.63, closed at 38.59. NASDAQ was up 2.25, closed at 11,199. Small caps are up 2.8. The VIX fell 4.66. It's currently at 28.46, still really, really high. Canada was up 0.94, Brazil down 0.12, Mexico up 1.83. Over in Europe, Germany was up 0.94, UK was flat. It finished down 0.01%. France was up 1.94. Euro stocks was up 1.64, Netherlands up 1.94, Spain up 1.49, Italy up 1.4, Switzerland up 1.68. Portugal up 1.59. All of Eastern or Western Europe was up between about 1.5 and 2. The Russian markets, let's see, they were both up. MOEX up 3.23. The RTSI up 2.66. And overnight in Asia, Japan was up 1.02. Australia up 0.28. New Zealand up 1.32. The Chinese markets were all red. Shanghai was basically flat at down 0.04. The SESE component down 0.51. The China A50 down 0.26. DJ Shanghai was flat at down 0.01, and the Hang Seng down 0.1. Taiwan weighted came in down at 1.48%. So definitely not as bad as yesterday for the Chinese markets, but for the European and domestic markets, things looked pretty good. So can't complain about that. Well, we could, but who's going to listen, quite honestly? So, all righty. Well, let's dive into today's market recap and see what happened in the world of finance here in America. The S&P 500 continues advance as falling yields boost big tech ahead of earnings. All right. The S&P 500 rallied as weakness in Treasury yields helped tech stocks ahead of quarterly results from Microsoft and Alphabet later Tuesday. Meta Platforms led the big rally in big tech, rising more than 5%, following by a more than 1% gain in Apple, Microsoft, and Alphabet. Microsoft and Google will kick off a busy week for big tech earnings after the closing bell, with demand for Microsoft Cloud segment Azure and the impact of slowing advertising spend, respectively, expected to be closely watched. Earnings from big tech will either expose the negative underlying fundamentals across the tech space and cause massive earnings cuts in 23, or prove the bearishness and demise of growth tech was premature, end quote, Wedbush said in a note. Falling Treasury yields also helped boost sentiment on big tech, as data pointing to weaker than expected consumer stoked further investor bets for less hawkish Federal Reserve rate hikes. The Consumer Confidence Index fell to 102.5 in October from a downwardly revised 107.8 in September. Economists were forecasting a reading of 106.5, so they were a little bit off by a smidge. Signs of weaker consumers didn't dent optimism about retailers as Bath & Body Works, Ross Stores and CarMax led consumer stocks higher. General Motors, meanwhile, jumped more than 3% after the automaker reported third quarter results that topped analyst estimates and maintained its full year outlook at a time when many are worried about weaker demand. General Electric fell 1% after mixed quarterly results as revenue beat estimates, but earnings fell short of estimates. UPS also reported mixed quarterly results driven by weakness in its supply chain solutions business. JetBlue Airways also reported weaker than expected earnings, even as the travel demand paved the way to hike fares, offsetting rising input costs somewhere. In other news, Elon Musk reportedly told bankers financing the debt portion of his $44 billion Twitter deal that he plans to wrap up the transaction by Friday. Wow, that's just 3 days from now. Bloomberg News reported on Tuesday. So sounds like earnings are coming in pretty good. So that's definitely some good news. And, maybe the downturn that we're experiencing will, be over sooner than later. Again, it's typically an 18-month cycle. So we're only about 10 months in from January 4th, which was the peak of the last of the market. So, all right, on to oil prices, energy. They are on the rise again. Oil prices rise on weaker dollar, supply worries. And when the dollar weakens, it's not surprising that commodities go up in price. Oil prices edged higher Tuesday, rebounding from an early fall of more than $1 a barrel on a lift from a weaker dollar and supply concerns highlighted by Saudi Arabia's energy minister. Brent crude rose 26 cents to settle at $93.52 a barrel, while WTI crude futures rose 74 cents to $85.32. Both benchmarks rose and fell by $1 during the session. Gas. The U.S. dollar index fell during afternoon trade, making greenback-denominated oil less expensive for other currency holders and helping push prices higher. Further support from comments by Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, that energy stockpiles are being used as a mechanism to manipulate markets. Well, that's not good news. Quote, "It's my duty to make clear that losing emergency stocks may be painful in the months to come." Quote, he told Future Innovative Investments Conference in Riyadh. Meanwhile, tightening markets for liquefied natural gas worldwide and supply cuts by major oil producers have put the world in the middle of, quote, the first truly global energy crisis, end quote. Fatih Birol, the head of International Energy Agency, said. Comments out of Riyadh and from the IEA are, quote, a reminder that when it comes to the energy crisis, it's far from over, said Phil Flynn, an analyst at Price Futures Group. Quote, there are still concerns the market is undersupplied, end quote. So, I think energy prices are probably going to go up over winter. That's kind of my forecast based upon everything that's going on, with the demand in Europe, especially with some pipeline disruptions, with the Russia-Ukraine stuff going on. So we shall see, but I don't think things are going to get any cheaper anytime soon. All right. Yesterday, we talked about the Chinese markets and how they fell so dramatically. And here's an article from Bloomberg. I'm just going to hit a couple of high points in here as far as why the markets took such a nosedive. It's titled Xi's Power Grab Spurs Historic Market Rout as Foreigners Flee. A sense of exasperation swept across Chinese markets as President Xi Jinping moved to stack his leadership ranks with loyalists, with stocks capping their worst day in Hong Kong since the 2008 global financial crisis and yuan weakening to a 14-year low. The Hang Seng Chinese Enterprises Index, a gauge of Chinese stocks listed in Hong Kong, plunged 7.3% in its worst showing after any Communist Party Congress since the inception of the index in 1994. Foreign investors fled mainland markets, selling a record amount of equities via trading links in Hong Kong and fueling a nearly 3% loss in the CSI 300 index. The onshore yuan fell as much as 0.6 to its weakest since January of 2008. The market meltdown following the reshuffle, which highlighted Xi's unquestioned grip over the ruling party, shows deep disappointment over a likely continuation of policies stacked on COVID zero and state-driven companies. Tech giants Alibaba Holdings, Tencent Holding, and Meituan all tumbled more than 11% as investors remain skeptical that Xi and his allies will seek a rejuvenation of private enterprise. Quote, the market is concerned that with so many in Xi's supporters elected, Xi's unfettered ability to enact policies that are not market friendly is now cemented, end quote, said Justin Tang, head of Asian research at United First Partners. So I think that was basically everything I wanted to cover there. So I had seen that over the weekend, or I guess late Sunday, when that went down in China. I just wanted to, verify that, that was in fact, the reason why the markets in Asia or in the Chinese space fell so dramatically. All right, last article here. Economists, Fed to hike 75 basis points again, should pause when inflation halves. So I know this is a big topic of debate, and people are really worried about, or at least the financial journalists and the people who are, worried about big tech and all that good stuff, are really concerned about when the Fed is going to stop raising interest rates. It's like, well, inflation is still a mess, so I don't think anytime soon. So let's go ahead and dive in. The U.S. Federal Reserve will go forth with its fourth consecutive 75 basis point interest rate hike on November 2nd, according to economists polled by Reuters, who said the central bank should not pause until inflation falls to around half its current level. So right now it's at 8.2, probably needs to get down into the 4% range before they even consider, really slowing down their tightening of the economy or of interest rates. The most aggressive tightening cycle in decades has brought with it even bigger recession risks. The survey also showed a median 65% probability of one within a year, up from 45%. Still, a strong majority of economists, 86 of 90, predicted policymakers would hike the federal funds rate by 0.75 of a percentage point to 3.75 to 4% next week, as inflation remains high and unemployment is near pre-pandemic lows. Diving down here a little further, quote, Fed officials have indicated that pausing is only possible after clear and compelling evidence inflation has moderated, end quote, said Brett Ryan, senior U.S. economist at Deutsche Bank. Quote, with the Fed continuing its aggressive tightening to rein in persistent inflation, we expect a moderate recession likely to begin in Q3 of next year. And that's actually, echoes what Brian Westbury said in yesterday's article that we covered, as the real growth rate would dip negative and the unemployment rate will rise substantially, end quote. So looks like we probably got a while before, unless inflation just plunges, dramatically in the next, month or two, which I just don't see happening based upon everything else that's going on in the world. So, we do have probably, quite a while before, we get those rates to moderate and, maybe start to fall back a little bit. But, they're still not that high. Again, I've talked about this a lot in recent meetings that, most of the mortgages I had over the years, in the late 90s, early 2000s, they were in the 6 to 7% range, which, that was just the going rate for, top, good credit. So now if you had, poor credit, it was certainly a lot higher than that. But, for cars and houses, that was just typical. We've just gotten really used to over the last, 10, 15 years of, exceptionally low, near zero Fed funds rate. And, that has allowed, mortgages and or mortgage bankers and other lenders to, discount their rates dramatically. So, I think things are just more getting back to normal as opposed to, it's certainly not like the interest rates of the late 70s and early 80s where, like my parents were paying 12% on their mortgage from 1978. And again, that was just typical at the time. You could pick up CDs in the late 70s and early 80s at 15%. And, I remember from my Series 7 class when I was getting licensed back a decade and a half ago, he talked about his mother, how he had sold her, bonds and CDs that had just, obscenely high rates, and she wasn't going to sell them because they were just so good and they were paying such good, income streams that it was there was no sense in getting rid of them. So, all right, well, that's everything we had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. If you'd like to book a meeting to start financial planning or get your finances back in order, or just to get your asset allocation in line with where we're headed, feel free to do so. Also, you can send me an email or drop me a phone call. All that information is there. So hope everyone has a fantastic night, and I'll be back tomorrow. So y'all have a good evening. Bye-bye.